defending the free market, and making the moral case for capitalism. The Justin Moore Show. Hey everybody, welcome to the Justin Moore Show, where we make sense of what's going on in this crazy, insane, out-of-control world. Now, I am back, ladies and gentlemen. I am still a little bit behind. I was thinking I was going to be able to catch up because I had the part 1, part 2 with Keith Weiner, but that still didn't happen. I'm still behind. Now, why is this? Well, last week I decided I was going to take my mom and dad to Chicago. Since I can fly for free, my parents can fly for free, and at the Billings Airport, we had our Chicago flight that ended just a few days ago, and I wanted to take advantage of, I've never been to Chicago. When you have a straight flight somewhere, it's a 2.5 hour flight, you got to take advantage of it. So I had to take advantage of that opportunity and went on some tours, prohibition tours and all that, and I found stuff. It was fascinating to see it firsthand. Getting upgraded to first class was pretty cool. Got my little breakfast in the morning, got my dinner on the way back. And that's the thing. Whenever there's opportunities that present themselves, that's one thing I do pretty well is I don't hesitate. I just go for it. Even though it's like, crap, I don't really have time to do this. But, we left Tuesday morning. We came back Wednesday night. It was a very short trip. Only stayed one night in Chicago. And there's so many fascinating things I learned. Actually, let me tell you guys one thing. The libertarian in me, when I heard this when I was on the Prohibition tour, the guy was pointing out that, during Prohibition, there was around 10,000 speakeasies around the city of Chicago. Speakeasies, that was where places where, at the time of Prohibition, alcohol was illegal. Well, the speakeasies were places where you could still get alcohol. So it was the black market, essentially, people working underground. So there's 10,000 speakeasies during Prohibition when alcohol was illegal. And now today, in the city of Chicago, there's around 2,400 bars. So you had more access to alcohol when it was illegal than when it's legal today. And when I heard that statistic, I'm just kind of, nodding my head. It's like, yep, no kidding. No surprise there. So it's kind of interesting just hearing little things about that and just kind of learning about the history of it. And, I got to see where John Dillinger was shot and, this little alleyway and all sorts of neat stuff, which I find very fascinating. So Chicago was a good time, and just there for basically a day. Still got to see quite a bit. Got to go to the top of Willis Tower, and it's just it's a big city. Living in Montana, that's what I like about being able to travel wherever I want. Whenever I want, I don't really have to pay for it. If I want to go visit a big city to go get the big city experience, I can. But then I come back to my little place here in Montana, where the population is just under 1 million for the whole state of Montana. We're like the 4th largest state. There's more cattle than people here, which is kind of the way I like it. So anyway, guys, I am back, and it was a really great time. I still plan on going on the Contra Cruise, even though I still haven't signed up for it yet. And anyway, now getting into the news here, you see, heck, I've just did an episode a few weeks ago talking about how Illinois is broke, the state of Illinois. Well, it's just in Illinois. Well, now we look at this Wall Street Journal article that I found. That's by this Josh Zunbrun. And he starts off with, this is a really well-done piece. And he starts off, U.S. household debt reached a new record of $12.8 trillion in the second quarter, driven by rising mortgage debt, a strong quarter for auto loan originations, and an uptick in credit card balances, which reached their highest level since 2009. Today's report marked the 12th consecutive quarterly increase in household debt. As Americans continue to re-embrace credit as the financial crisis recedes into memory, the total volume of debt is now $1.7 trillion higher than it was in 2013, according to the Federal Reserve Bank of New York's quarterly report on household debt and credit. Okay, so we have record household debt of $12.8 trillion. And that's the highest level we've seen since 2009, since basically the bottom of the crisis in 2008. And what we've seen in the last 12 consecutive quarters is an increase in household debt. People are taking on more and more debt, whether that's, their mortgage debt, buying a new car, so auto loan debt or credit card debt or student loans. All this is adding up. And so the debt just from 2013, so just 4 years ago, it's $1.7 trillion higher than it was then. So, I mean, it's just amazing how much debt we continue to add. And what I want to do here, I'm going to go through the rest of this piece. And this guy is kind of making the case that I make about debt and how it's unsustainable. But then I have just a few sentences I want to read from this guy who sees things completely different. That, oh, it's fine. It's nothing to worry about. And so I just want to give you guys that contrast. So let's just continue here. While overall debt has increased, the figures aren't adjusted for the growth of the population or the economy. Total debt was 67% of the nominal gross domestic product in the second quarter, down from as high as 87% in 2009. The increase partly reflects renewed confidence in the economy as Americans are more willing to purchase homes and borrow to fuel consumer spending. But there are signs that some households are becoming overstretched, with a rising share of credit cards going delinquent each quarter. Okay, and this is, now get this statistic here about credit card debt and credit card delinquencies. About 6.2% of credit card balances became 30 days delinquent over the quarter, an increase from 5.1% in the same quarter a year ago. Though on the rise, it's still well below the amount of delinquency seen during the financial crisis, which as much as 13% of balances were going delinquent. The share of credit cards becoming 90 days delinquent has also risen, an early sign that some borrowers are becoming distressed. Okay, so just to clarify, because that's a lot of numbers, you're hearing all that, it's like, what's going on here? Okay, so we've seen 30-day delinquencies on credit cards. It's at 6.2% right now. A year ago, it was at 5.1%. So that's increased. But to look at this on the bright side, in the midst of the financial crisis in 2008, 2009, we saw 30-day credit card delinquencies up around 13%. So they still have a ways to go, basically double from where they're at now to reach those levels. But they're on the rise. And a little indicator to look at here is to look at the 90-day delinquency rates. Because when someone's 90 days delinquent on credit cards, okay, you're 3 months behind at that point. So that's showing how distressed borrowers are getting. Like, they're really falling behind. They can't make it happen. They're ready to just, declare bankruptcy or whatever. They can't rub two pennies together, basically. And so we're seeing 90-day delinquencies, they're also on the rise. And just to continue on here, while relatively low, credit card delinquency flows climbed notably over the past year, said Andrew Hawat, a New York Fed economist. The current state of credit card delinquencies flows can be an early indicator of future trends, and we will closely monitor the degree to which this uptick is predictive of further consumer distress. End quote. Okay. And then I just have a few paragraphs to read from this piece. I mean, it's so well done, I just kind of have to read all of it here because there's just a lot of great numbers and kind of gives you an idea of what's going on here. And he continues. Total credit card debt climbed by $20 billion in the second quarter, reaching $784 billion in the highest level since the fourth quarter of 2009. The quarter also showed strong increases in auto lending, with $148 billion of new auto loans originated in the quarter, including $51 billion of loans to borrowers with credit scores under 660, which are considered subprime. Both figures are near the highest levels of the past 10 years. The total volume of auto loans rose by $23 billion and is now at a record $1.19 trillion. Okay, what's the key from what I just read right there? It's at, so we had $148 billion of new auto loans that originated in the quarter. $51 billion, so I don't know, what is that, like about 33% of the total auto loans are going to people with credit scores under 660, people, loans that are considered subprime, people who most likely won't be able to, they most likely will default on their debts. I mean, right now, if you're buying a vehicle, you're assuming, okay, you're going to have your job, nothing's going to get worse. It's already as worse as it can get. and you're going to do just fine. You'll be able to make your little payments and you'll get through it. But that's more optimistic than they realize. So let's just continue on here, and we'll kind of get back to these figures a little bit later here. Auto loans are showing some increased signs of distress as well. Various measures of delinquencies have been slowly rising for the past 4 years. Student loan balances were unchanged in the quarter. The figures aren't seasonally adjusted and due to the academic calendar. Few students take on loans in the second quarter. The biggest category of household borrowing is for mortgages. Total mortgage balances increased by $64 billion in the quarter. Borrowing for mortgages has been slow to recover since the financial crisis and remains about 6.5% below its peak in 2008. Delinquency rates on mortgages have dropped after spiking during the financial crisis and are now the type of debt with the lowest delinquencies. The data is compiled by economists at the New York Fed and based on the borrowing records of millions of consumers that are compiled by the credit rating agency Equifax. Okay, so there was that piece in the Wall Street Journal. I read the entire thing. Okay, so I think it was just really well done, pointing out where and how they're increasing their debt. And so now what I came across, what I found really interesting, is this piece from a guy from Bloomberg, and his name is Barry Ritholtz. And he's basically pointing out a different way of looking at this, saying, no, it's nothing to worry about, all this stuff. And I only have probably 6 sentences to read from this guy, but it will kind of get you an idea of what he's coming from, and I'll explain it. Consider the conditions of the consumer and housing market then verse today. Yes, it is important to have a cash cushion, but it's more important to understand the total potential liability of potential debt. Many people failed to understand they were sitting on ticking time bombs of resetting mortgages, whose low teaser rates were going to eventually reset at much higher levels. A home mortgage that was affordable at the outset suddenly became impossible for borrowers to service relative to their incomes. Given how many securitized financial products were built on top of these mortgages and derivatives built on top of them, the financial collapse was all but inevitable. This bears little resemblance to today. The quality of borrowers is much higher. Debt-to-income ratios are much lower. If anything, the banks have tightened too much, denying credit to borrowers who would meet traditional lending standards. The simple ability of the average American to service their debt is nothing like it was a decade ago. But as long as too many pundits and commentators are unwilling or unable to master the basics of economic context and simple math, we're doomed to these predictable episodes of hand-wringing. Okay, so there, just right there, that gave you a really good taste of how this guy thinks about what's going on here. You can tell he's a well-meaning guy, but I think he's completely off base. Okay, he's basically pointing out, okay, in 2008, look, the reason we had problems because the consumer wasn't knowledgeable. He didn't realize they were just teaser rates. The guy thought, oh yeah, I can afford this at this interest rate, but he didn't realize the interest rates were going to go up. And then when they did go up, they couldn't afford them, and so they had to default on their mortgages. So he's pointing that out as one of the problems. And then, he's pointing out that the borrowers of today are of much higher quality than they were back in 2008. One of the statistics I just read pointing out that basically 33% of auto loans right now that originated last quarter are going to people with a credit score under 660, which is considered a subprime loan in the car industry. So besides buying a house, what's the most expensive item that the average person buys? Well, it's a car. And let's not forget either that housing prices today are about where they were prior to the collapse of 2008. We never fully deflated the housing bubble. Yes, it went down a lot, but we've reinflated it. The Fed's been buying mortgages, mortgage-backed securities. We've reinflated the bubble, and it's at bubble levels again. So we're going to see the popping of that bubble again. We'll see the auto sector blow to pieces. We'll see these dealerships asking for bailouts from the government again. Will a President Trump act like a George W. Bush and bail out a GM and a Chrysler? This is so obvious to see. But, a guy like this, he's pointing out that, look, there's nothing to really worry about. As long as people can service their debt, then whatever these numbers are, I mean, yeah, if you adjust them for population, the debt doesn't seem as bad as it was back in 2008 from that perspective. But the key thing this guy gets wrong is that he's assuming that they can service their debt, these people. Based on how things are right now, as long as things don't get worse, sure, they're able to barely squeak by. But actually, they're not really squeaking by when we're starting to see a slow uptick in credit card delinquencies of 30 and 90 days. Auto loan delinquencies are slowly ticking up. People right now can't service their debt. So what happens when this next crisis comes? When millions of people, when hundreds of thousands of people lose their jobs, when there is this really, really bad recession, we're going to see delinquencies, they're most likely going to go way above where they were 2008, 2009. Those credit card delinquencies we saw, of around 13%, will easily surpass that. And that's why I've made the point on my show here is to hold off on buying your new vehicle or a used vehicle. Because when there's a lot of people going delinquent on car payments, when the banks have to repossess vehicles, they're going to be repossessing a lot of vehicles. A lot of people have bought vehicles that they never should have bought in the first place. And that's what we're seeing right now. And so that's why, listeners of this show, you guys know, most people can't identify this stuff as a bubble. The average person out there, they wonder why they keep getting raped over the coals over and over again. It's like just when they think things are great, oh yes, I got some spare cash, let me invest it in some tech stocks. They were doing this in 1999. Then they lose it all. Then they're like, whoa, look at, I can start flipping houses. I can make 50 grand like it's nothing. Oh man, okay, let me double down. Let's leverage this up so I can be making hundreds of thousands of dollars doing this stuff. And those people got wiped out again. Well, now here they are. And we're setting it up where once people think things are great again, they're going to get wiped out. So that's why Austrian economics, understanding where bubbles are at in the economy, we can prosper from that. We can see where the misallocation of resources has taken place. And eventually when the bubbles pop, when resources are finally allocated to their most efficient uses, that's where your money should be going. What industries truly are not in a bubble? That is the direction. I mean, as an entrepreneur, you got to think, okay, you got to think ahead of the people. Where is demand going to be in the future? What services are going to be the most needed in the future? And so that's where you should be investing your money, not trying to chase rainbows and leprechauns. That's what the average person does, and they always lose because you're always behind. You got to be ahead. And I hope, listeners of this show, I hope you guys get that. And you must get that. You must understand, because if you understand the Austrian economics, you certainly understand the economy in a way that's completely different from anybody else out there. Everybody out there just watching CNBC, Fox Business, all these guys do day in and day out. I don't even watch this stuff. But when I did, I'll just flip it on for 5 minutes. They're talking about consumer spending. Oh, the consumer is hurting. Oh my God, what's this mean for the economy? They're always talking about consumer spending, but consumer spending is always following. It's never the cause of prosperity. That's what they don't get. Consumer spending is a lagging indicator. That just kind of shows, okay, it's the idea of Say's law, in order to consume, you must first produce. So, as a consumer, you first had to produce, you first had to provide services, you had to work at a job, and then based on your income that you have, where are you putting it, And the key is with an economy and a growing economy, it's all about production, producing more, becoming more efficient. And so the mainstream press, they just don't get it at all. And most people just go along with it. Like, okay, yep, got to keep consumers happy. Like George W. Bush, when he was in office, they had this brilliant idea of the stimulus plan. Yes, let's give each person back, what was it, like $250, whatever it was, so we can get the consumers spending again. Go out and help the economy. That is a Keynesian idea. Keynesian economic ideas have destroyed our economy over and over again, and all we hear are people blaming capitalism for the booms and busts. No, it is Keynesian economics and the idea that government can help stimulate the economy. And by the Federal Reserve artificially lowering interest rates is good for the economy, to help goose the economy. And the idea that the Federal Reserve and the Fed officials somehow know at the right time to pull the punch bowl away so that they can prevent a crisis from occurring. That is a bunch of BS. But that's what kids are taught in college. And this next crisis that's coming, I hope more people wake up and start to understand maybe how things are supposed to be, but I highly doubt it. There's always an scapegoat, always someone to blame. But this next crisis is going to be much worse than anything we've ever seen before. So it's going to be a huge opportunity for people who think like you and me to point out and just look at the credibility we've had. I'm sure a lot of you guys have posted things on Facebook or Twitter. You'll be able to show your friends and family, hey, look, I was predicting this was going to happen. Look what I said here. Look what I said there. And you can be the opinion leader in your little group. And just imagine the strength we can have when all of us are influential in all of our own little circles. And so it's important that we keep ourselves informed. And that's exactly what you guys are doing here, just listening to my show at this point in time. So anyway, guys, that is all I have for you on today's show. If you guys can, just go to my website, go to justinmooreshow.com. Moore is spelled M-O-H-R. If you buy your old Amazon goods through my link, I get a small commission back. It costs you nothing extra. A great way to help out the show. And also, if you guys want to donate to my show via PayPal, if you donate on $50, I send you my bonus episodes. Or join Tom Wood's Liberty Classroom. Tom Wood's Liberty Classroom, a great way you want to expand your knowledge of libertarian thought and ideas and history, the real history that you didn't get, understand Austrian economics on a higher level. You should go join Tom Wood's Liberty Classroom. And for a limited time, and at least before the Contra Cruise, you join Tom Wood's Liberty Classroom through my link. I'm going to send you my bonus episodes, and you're in the drawing for the silver coin that will occur in October. So anyway, guys, that is all I have for you today. I will talk with all you guys next week, and I'm looking forward to it. This is Justin Moore, signing off.